Can you help me relate to who sets mortgage rates? Is it really the Federal Reserve? 'Cause that's what I thought I heard. Or is it forces that I can't see? Will you explain it all to me? Hello, this is J. Mike Perkins, and welcome to Music and Mortgage. And on this episode, who sets mortgage interest rates? So who sets mortgage interest rates? Well, it's not the Federal Reserve. The Federal Reserve sets two types of interest rates. One is called the federal funds rate. The federal funds rate is the rate that banks charge each other for short-term overnight loans. And the other one is the federal discount rate, which is the rate that banks pay when they borrow money from the Fed. Now, even though these two rates don't have a whole lot to do with a 30-year fixed mortgage interest rate, when the Fed starts shaking things up, it's going to have an effect. Let's say the Fed is this giant and interest rates for different kinds of loans are inside this snow globe. When the Fed starts shaking the globe, rates are likely to change, but it's hard to tell exactly where they're going to end up. You should not assume that, say, a 0.25% increase or decrease in the federal funds rate is going to equal the same amount in a mortgage rate. It might or it might not. What is important, however, is to look for interest rate trends. The Fed meets periodically, about once every other month. And if they do something in one meeting, say an increase or a decrease, and then they do the same thing again in their next meeting, and then they make comments about doing the same sort of thing in the future, that is the sort of thing that's going to affect mortgage interest rates. So if the Federal Reserve does not set mortgage interest rates, well then who does? To understand that, you need to understand how the mortgage business works. Now, there are some exceptions, but in the vast majority of cases, the business model is built around making a mortgage and then selling that mortgage at some kind of a profit. And determining what the lender can sell the mortgage for is going to determine what they charge the borrower for it. About 3 out of 4 all mortgages are sold at some time. But for the popular loan programs like conventional and FHA, which make up 75% of the market, it's more than 75% are sold. In some years, it's almost 100%. And that's just a gigantic trillion-dollar business. Now let's look at how a normal business selling a physical product operates and how a mortgage company operates. If you're selling something physical, say a blender or a lawnmower, odds are you're going to buy that product from a wholesaler, and the price that you pay the wholesaler is going to establish your cost. You're going to sell it for more than that and then make a profit. For a mortgage company that is selling their loans, first of all, they're going to get contacted by a borrower, and let's say they want a 6% 30-year FHA mortgage. Before the lender quotes a rate and a cost for that, the first thing they're going to do is figure out what they can sell a 6% 30-year FHA mortgage for. And then what they can sell it for, plus their profit, is going to determine what cost they're going to give the borrower. That's not to say that all lenders are going to have the exact same interest rate on the same loan. Some lenders may have a lower cost than another lender, and perhaps they're able to pass some of that savings on. But even if two lenders have the exact same cost, one lender's rate may be slightly lower because they're willing to accept a smaller profit margin. The price that the lender gets when they go to sell your mortgage is not set by any particular person. It's set by the marketplace. Let me explain how that works. First, mortgages get grouped together. A group of mortgages is called a pool of mortgages, just like you have a herd of buffalo and a pack of dogs. These pools of mortgages then get turned into this thing that has a name that only an accountant could love, a mortgage-backed security. Then the mortgage-backed security is sold to the public. So if you owned part of a mortgage-backed security, you would own part of a loan pool, and you would be entitled to the payments from those mortgages less a fee for processing. Mortgage-backed securities are very popular investments. In most cases, not all, but in most cases, they contain some sort of a guarantee. If you have a retirement plan or something like that that has a whole bunch of different assets in it, and you see a category labeled fixed income, there's a good chance that at least some of those are mortgage-backed securities. And the price they sell for is based on the rate that they pay, and that is the main thing that's going to set the lender's cost and ultimately their interest rate. The final thing to remember about interest rates is no one really controls them. They're almost like a force of nature. They go one direction and then something changes and they start going back the other. And that's just the way that it works. You can't control them any more than you can control the weather. Thank you very much for watching. This is J. Mike Perkins. If you're watching on YouTube, please help my channel by hitting like and subscribe. And if you're looking for a mortgage on a property in Texas, I can help you, and my information is at the end of the video. And now, more music. As you climb the mortgage mountain, 'cause you wanna buy a house with a fountain, then maybe you should give me a try. Just click the QR code and apply. Thank you very much.